On today's hot sheet, I'm discussing housing inventory, 2023's listing deficit, and NAR's pending home sales index. Today is Tuesday, January 2nd, 2024. I am Byron Lazine, and the hot sheet starts now. Welcome into the first hot sheet of 2024. This is year two of the hot sheet after having a full run in 2023. You can still use code FROSTY to get the most out of all of our content at BAM, including the best out of our content for the hot sheet by joining BAMX. Use code FROSTY to get the major 25% discount off of BAMX. Still going on today, and I think extending maybe for another day or so. So 2023 was a wild ride, not as wild as 2022. 2022 was a real estate market like none of us have probably ever seen, certainly going back to the GFC. But 2023 was tricky. It was particularly tricky for agents. But you still had a lot of those COVID agents lingering around, still had their license, still kind of putting their hand into the pot, which shrunk considerably. That pot of total transactions got to be a real low point, certainly in fourth quarter, getting down to as low as 3.7, 3.8 seasonally adjusted, 3.8 million, that is seasonally adjusted transactions. Big reason for that, of course, was inventory as well as rates. Let's get into inventory as we do when we kick off the hot sheet every single week. It is what can help us the most with affordability in this market. If we take a look here, according to Altos Research, and for those of you that are new to the hot sheet, if you're new to the hot sheet, make sure you subscribe to the BAM YouTube channel, hit the notification bell so you don't miss one of these. Every Monday, today being Tuesday because of the holiday yesterday, every Monday we go over inventory for the last week. We dig into Altos Research, courtesy of Housing Wire, and break it all down for you on the macro, so that you can relate the macro to what's happening in your micro. Okay, so weekly inventory change here for last week was 528,000 down to 513,000 active listings onto the market across the country. Active listings, the way Altos Research describes it, would be the way you think about it if you're an agent. NAR goes with inventory on active and pending. So if it's pending or show status in your MLS, they group that into inventory. Not Altos, they break it apart from what's truly active into aside from what is pending. Okay, so down from 528,000 the same week last year to 513,000 this past week. But I got great news for you. That's better than where we were last year. Okay, so I'm sorry, the 528 to the 513 was just in the last week. That fall was in the last 7 days. Going now to last year, during the same week, it fell from 508 to 490. So if we just do a year over year comparison, right now we're sitting at about 513,000 active listings across the country. And the same time this week last year, we were at 490,809. These are obviously still historically low numbers. They're much lower than where we want them to be, but we're starting the year of 2024 in a little bit better spot than we did in 2023 as it relates to active listings. We're about 25,000, just under 25,000 active listings on the plus side kicking off 2024. It's well off of where we were obviously in 2015 when we had over 1 million homes actively on the market during this week alone. But I'm going to take the good in all of this, and hopefully we can start as a market, start to build upon those numbers. We need a big January on new listings. Let's get into new listings because new listings were very interesting this year. We're going to get into a new listing deficit report from Resi Club here in just a little bit that Lance Lambert put together. Teaser alert, by the way, teaser. Friday, Knowledge Brokers podcast. Lance Lambert is kicking off the new year with myself, Tom Toole, and Lisa Chinati on his 2024 predictions. If you don't know Lance Lambert, it's one of the best Twitter X follows you could possibly be doing as a real estate professional. Okay, new listings. Here's some more good news. Right now, this week, we are better on the new listing data than we've been each of the last 2 years. Not as big of a gap as active listings there, but we're better. We're improving. Okay, 24,394 new listings in the past week, where last year we saw less than 20,000 in 2021. It was just under 22,000, and you can see this dark red line here sitting above the last 2 years for new listings. So new listings is starting to improve, starting to show early signs of potentially getting a little bit better. But we got to put this all into context. For all of those who said, here's a big prediction that was wrong in 2023. We didn't get it wrong here on the hot sheet. Those of you that remember January, February, March, I was talking about inventory and the market being in a cold war. Lance Lambert, who I just referenced, he talks about it being in the lock-in effect. That's been a national way to describe, they started talking about it late spring, right? Where they started saying, hey, we're in a lock-in effect. People aren't selling their home because the rate is so high, and this is reducing inventory and bringing inventory down. Maybe their term was a little more politically correct, but before there was a national term, I was just calling it a cold war in real estate, where buyers and sellers just have nothing to do. They're just sitting there because the sellers, the homeowners, don't want to put their homes onto the market. So for all of those that said, well, the rates are so high, we're going to see inventory explode in 2023. And there was a whole bunch of those folks out on YouTube and other places that were saying this nonsense going into 2023. They've now been proven dead wrong. Not only were they wrong about the inventory, but most of them also said, we're going to see another 2008. Now, we know that there's nothing comparable to today's market and 2028. Let's just take a look at new listings as an example. New listings, we just looked at the last 3 years. If we just average those out, that comes out to 21,753 new listings for this week. Okay, we saw 24,000 is what we saw in the last week. But if we average the last 3 years, it's 21,000 plus. But let's just take the 24,000 number. Okay, 24,000 in the last week for new listings. In 2028, that number for just this past week was 249,655 new listings, more than 10x on new listings in the last week of December. 2008, last week of December, 250,000 new listings across the country, compared to what we just experienced was 24,000. We're still a long way away from new listings and inventory getting to not only a healthy place. Obviously, 2008 was an abnormal, unhealthy market, but there's such a significant gap in new listing data from what was happening during the great financial crisis. And in fact, from 2008 to 2011, new listing data averaged between 250,000 and 400,000 every single week. Okay, week over week over week. From 2008 to 2011, new listing reads were coming in between 250,000 and 400,000. We don't have any data in the last 12 years that relates to that market in any scenario whatsoever. Obviously, we know in 2011, 2009, 2011, all of the banking and mortgage changes that were made that have certainly changed the game for buyers as well, and changed the health of the home buying market. It's made it harder, and it should have, because it was quite easy back then. Let's take a look at price cuts as we typically do here to kick off the week. We're still below last year's level, 2022, when we ripped the Band-Aid off of the low interest rates. 38% same week last year for price cuts, 35% for this past week. So trending below 2022 levels, but above 2021 levels when we were at 24%. Okay, so there's your week over week data according to Altos Research, put together by Logan Motoshami at Housing Wire. Just speaking of Logan Motoshami really quick, I want to go through a couple of his projections here. I mentioned, if you were over on Instagram Live, I mentioned that the 10-year is we're waking up here on January 2nd. We're going to get into the 10-year at the end of the show, but the 10-year is a little bit above where we might have left it in 2023. Maybe you didn't pay attention to last week. You really didn't do much, but it's all of a sudden a little bit above. The stock market all of a sudden waking up on January 2nd is down. I was thinking, I mean, yesterday I was having a conversation with somebody who trades a lot of equities in a cigar lounge here in Connecticut. And I said, hey, what do you think the market's going to do tomorrow morning? You think it's just going to get off and rip? And we're just kind of having a, theoretical projection conversation. I wake up this morning like, wow, pre-market Dow is down 200 points. Let's see where it is now off of the market. And it's down about 100 points here after market opens. So down 0.25%. Not a big deal. Not a big deal at all. S&P's down, NASDAQ's down. These aren't big numbers. These aren't anything to worry about. But you also see the 10-year here ticking up. And so I got beat up a little bit on my Instagram on my projections for 2024. You can go check them out, or you can listen to Knowledge Brokers podcast from last Friday, where I have all my predictions of what's going to happen in the 2024 market. One of my predictions was, hey, over on the 30-year fix, 6.375. Hope I'm wrong. That's under where that over and under is under where we sit today here at 6.6 or 6.67. But I said over because I still think there's going to be some bumps ahead. Today would be one of those signals of those bumps where the 10-year it's dropped considerably since Jerome Powell's conversation in December, but it's not on a free fall. We'll get into a little bit more of that here at the end of the show, so stick with me on that. But here's forecast from Logan Motoshami, his forecast for 2024, giving a pretty big range here on the 10-year, 4.25 to 3.21. would be his projection on the 10-year. Mortgage rates between 7.25 and 5.75. I think we can all agree we'd root for the 5.75. We'd root for sub 6 on an interest rate. That would be unbelievable. A key level to watch on the 10-year yield, according to Motoshami, is 3.37. To go below this level last year, labor would need to break. So he borrowed the Gandalf and Gray's catchphrase, "You shall not pass." And the 10-year yield did not pass that level in 2023. Now, what I will say is if you go back to his 2002 projections, it did pass the higher level. He said, no chance we go above, I think it was 4.25, which is pretty similar to his 10-year yield range for this year. And of course, we broke 5% on the 10-year towards the end of the year before falling back down below 4. Which was a low since 2000 or the lowest point in the last couple of years. If so, he's saying that the 10-year yield will not go below 3.37. However, if labor or economic data gets weaker, you could break through that line, which means 2.72% on the 10-year yield could be in play for 2024. Now, like we hear 2.72% on the 10-year, based off of the spread today, that would mean that the 30-year fix on an abnormal spread from the 30-year to the 10-year today, that would mean we're below 5%. On a normal spread, you'd be below 4% with a 10-year hitting 2.72%. If we had a normal spread right now, relationship between the 10-year and the 30-year, we'd be under 6% today. Okay. That means, though, that the labor, listen to what he said there, the labor market, the economic data needs to get weaker. In layman's terms, people need to lose their jobs for that to get that low, in Logan Motoshami's opinion. Okay. So this is his projection, which is backed up by significant data. Okay. So in order for the rates to get ridiculously low, you've got to see some significant job loss, some weakening of the economy. What happened this year was the economy continued to grow. It was very strong. The labor data was incredibly strong. We had moments of like 50-year lows on unemployment at times this year. So jobs was strong. Economy grew greater than any expectations. And that kept pushing up that 10-year. Okay. The spread between the 10-year is important to watch. It could mean that rates, if it normalizes, that rates could get lower without the 10-year having to drop. Again, if we were at a normal rate right now, we'd be below 6%. Okay. A couple other projections on home prices. He's got single digit, relatively speaking, single digit increases, unless you have rates come down to that really low, you know, below 5% range, and you had inventory continue to be stressed, then obviously you would see a takeaway on prices. Again, 250, he goes back into that new listing data here, 250,000 to 400 each week. The biggest week we've seen in any of the last 3 years on new listings is 90,000. Okay, so this is obviously keeping that inventory really stressed, and we'll have to continue to watch what happens there. All right, so there's just some projections on that. Let's talk about listings again here on the listing deficit in 2023 and compare it to previous years. I think that Lance Lambert did a great job of breaking this down on Resi Club. We'll have him on Knowledge Brokers podcast again this Friday. Go over to that channel, subscribe, hit the bell so you don't miss that. But throughout the 2023 housing market, we saw this sharp decline in new listings, as mentioned before, and Resi Club has now compared this to 2019. Okay, so what does this chart in front of you show you? If you're a BAMX member, by the way, you get access to all of the charts, the previous charts, every single day's chart that we do here on the hot sheet, as well as our show notes. I'll show you the show notes before we sign off. Use code Frosty if you're not a BAMX member. But this chart shows you that every single month since January of 2022, we've had a new listing deficit when compared to 2019. Why is 2019 a good market to compare to? It was the last normal market before abnormal times of COVID. So every single month since 2022, we've been missing new listings. We've been at a deficit of new listings. That's what's crunching this inventory issue more than anything. And I am personally seeing some early signs that that's changing. Those early signals we talked about here at the beginning of the stream, as well as just anecdotal evidence that agents, hey, I've got some listings coming on in January. I've got some homeowners talking about wanting to get ready, get prepared for the market, maybe kicking off earlier on the listing conversation than in recent memory. Lance Lambert tends to agree that we might have seen the bottom of the lock-in effect, the Cold War. In November 2023, there was a new listing deficit of negative 51,866 homes, which is slightly down from the 73,968 deficit in November 22, suggesting that the peak lock-in effect might be behind us, might have some homeowners starting to get comfortable with the fact that rates are slowly potentially coming down, but they're not going to free fall. And we're not going to get 2.75. We're not going to get 3.25 anytime soon. And if they want to make that move, the time could be now to go ahead and do that, or they might just be sick of waiting. Okay, so there's your new listing deficit report. Early signs that the lock-in effect could be behind us and that we are heading into the right direction. NAR at the end of last week, slow week, obviously, between holiday and New Year, did release their pending home sale data for November. Let's take a look. The index sitting at 71.6, an index above 100, coincides with a higher level of activity relative to 2001. So we're well below a high level of activity as it relates to the pending home sale data. The Midwest went up 0.5% month over month. Northeast went up 0.8% month over month. South went down 2.3%. But overall, South is kicking everybody's tail at 83.2 on the index, well below 100, but well above all the other major regions. The West, coming in the lowest on the index at 54, did rise month over month 4.2%. Nationally, we had a 0% increase on pending home sale data for November in comparison to October. Interesting to me because you would think October is a little better than November, but being flat with October might show, again, some signs that this winter could be fruitful for agents and for the home market. 10-year Treasury, again, referencing this earlier, coming in at 3.955, ticking up here this morning. So there's likely going to be a more not extreme volatility, but more bumps in the road when it relates to the 30-year fix. Just because we had a good 2 or 3 weeks at the end of the year last year doesn't mean we're on a free fall plummet on the 30-year fix. There's going to be ebbs and flows. And the market data, the jobs report that comes out later this week, which we'll cover here on the hot sheet as we cover all the economic data that impacts the economy and specifically housing, of course. And we just mentioned what Logan said about jobs. Jobs are going to be something to watch for the 30-year fix. They go, we have really low unemployment. You might see rates get pushed up a little bit. They go down, then you might see those rates come down. Nobody's rooting for catastrophic job loss, but it's something to watch. But there's going to be some more bumps in the road. You can't just plug and play what happened the last 3 weeks and be like, oh, rates are going to be down, certainly under 6% guaranteed. They look like they're going to go up today. There's going to be some days in here where we're going to have some bumps in the road. We ended last week at 6.67 on Mortgage News Daily's 30-year fixed. 6.61 was the final Freddie Mac 30-year fixed weekly survey. I would guess that this comes in flat. We've been very consistent the last few weeks, which is nice. Consistency to the rates. We're either going to come in flat or maybe even a tick up. Not a big deal. Okay. As we get more data on inflation, we're going to continue to obviously have to observe that and see how the markets react. Wall Street Journal put out a report this morning. Okay. Here's the rates versus the longer run estimate. Fed fund rate, obviously, they're potentially going to start cutting this year. The Fed's longer run estimate for Fed fund rate well below where we're at. So they mentioned, hey, we're going to start cutting. And you saw the markets get off to the races. You saw the 10-year obviously drop. Okay. But there are many that believe that maybe the market has reacted too much too soon. Okay. That just maybe we need to slow our jets. Some analysts warn that investors might have gotten ahead of themselves and that bond prices could fall if rates take longer than expected. Okay. Bond prices, could fall. The prices and the rates are inverted. Okay. So prices could fall if rate cuts take longer than expected. So why did we see the stock market go up at the end of the year? Oh, the Fed said, they're going to start cutting rates. Boom. People go into equities, go into the stocks. 10-year drops down on the rate. Okay. But prices could also drop if the growing supply of treasuries needed to fund the federal budget deficit starts to overwhelm demand. That's another thing that's going to impact the 10-year. Okay. We have a lot of debt in this country. Treasury needs to fund the federal budget. They go out and sell these notes, right? And so they sell these bonds. And so if we flood the market with too many, what has to happen there on the 10-year? The 10-year percentage that people are going to get on their money needs to go up. It needs to be more lucrative if we have too much supply of our debt. Conversely, bonds could provide a refuge in a recession with the prices rising as rates fall, but that could also also drag yields back to pre-pandemic levels, giving investors only a short-lived benefit. So there you go. There's just some worry that stock prices might already be too high relative to the earnings. We just can't take 2 or 3 weeks of data and say to our clients and investors in our database, oh, the rates are going to be below 6% this year. Hey, none of us have a crystal ball. None of us can play the prediction game. Here's what's happened in the last year. Here's what's happening now. Here's what's happened in our local market. Here are the facts. And let's base our decision off of that. For example, when somebody says, 2008, this and this happened. Hey, 2008, there was 250,000 to 400,000 new listings coming out every single week from 2008 to 2011. We just saw 25,000 new listings last week. don't expect any cliff in prices. Okay. The data suggests that that will not happen. Okay. And so, as Steve Harney quotes Ivy Zellman, I'll leave you guys with this here to start the year. I've done it probably 5 times on the hot sheet in the last year. It's my favorite quote. We would never suggest that a real estate company could be successful without fully understanding local market trends, but ignoring macro trends or assuming they do not carry the same weight would be an equally erroneous suggestion. In our experience, the most effective industry leaders appreciate the appropriate balance between the two ends of the spectrum. So I'll leave you guys here on the first show of 2024 with an understanding that the road ahead is going to have some bumps, that we as real estate professionals must understand what the road ahead is going to look like and understand that those bumps are going to come by absorbing the data every single day. That's why we're here for you to break down. It's the only live housing show on the internet. So certainly subscribe if you haven't done so already, so that you don't miss one of these updates. We go live every single day that the market is open. It's the only show that does it. Before I leave you guys, make sure that you subscribe or make sure that you are part of BAMX. Code Frosty is going away here. I know that it's extended here through today, maybe another couple days. So use code Frosty to get the lowest percentage off the annual off your first year and get grandfathered in at that rate, not the discount rate, but the current rate right now before it goes up for the lifetime of your subscription. You get the most out of everything we do at BAM, including hot sheet notes. The show notes that we release every single show like these are uploaded into BAMX every single day. So if you want the data for your show, for your email list, for your text message and conversations, you can get these show notes every single day by being a BAMX member. Use code Frosty. And if you need an operating platform for your business right now, take a look at Mosaic, Mosaik.io. Mosaic is the operating platform that helps real estate agents the most, as well as teams. This gives you everything: how to collect deals, how to categorize all your deals, how to operate your entire business. It's a powerful flywheel of not only repeat, but referral business. If you need a way to just run your business, check out Mosaic. We're going to put a link down below, mosaik.io. Check out Mosaic today. I'll be back here tomorrow on another hot sheet and looking forward to share it with all of you. Today on the channel, again, also at 2 o'clock, is our first Real Word podcast of the new year. So hope you can check that out later today. Have a great first day of the new year. Well, second day technically, but first work day. And I'll see you guys back here tomorrow. Till then, toodaloo.